today's CPE meeting on income from other sources. The session will be handled by Mr. Shreyas. Shreyas is currently working with Pricewaterhouse & Co. LLP, tax and regulatory practice based in Chennai. He is associated with the Pricewaterhouse & Coopers for the last 2.5 years. Shreyas is a qualified chartered accountant in the year 2015, and prior to qualification as a CA, he did his articleship in BMR and Associates, a tax consulting firm. He is yet to apply for membership. Over to Shreyas. But before that, let us race for IC Motor. Thank you, members. Over to you, Shreyas.
Very good evening to everyone present here. Kindly bear with the technical aspects and slight delay was available because of the earlier session. So we'll proceed with the topic for the day, income from other sources. So I'll try to explain what the provisions on income from other sources are, and certain key provisions pertaining to the gift tax aspects largely. So that's pretty much the agenda today, instead of dealing with each and every item of other sources. So as I told you, what we're going to do is scheme of taxation under IOS and the taxability under 5627, which pertains to receipts by individual HUFs, and taxability under 5627A, which is receipt-based taxation in the hands of a firm or a closely held company. And moving on, we'll be dealing with 5627B, which is more of premium taxation in the hands of a closely held company. Today, 5627 and 7A have been clubbed under the newly introduced provisions called 56210. So currently, 5627 and 7A are not applicable, but it was applicable until March 2017. But 5627B is still in operation. And then lastly, we will just try to see what taxability of dividends are, because dividends pretty much it's distribution tax in the hands of the company, while it's exempt in the hands of the shareholders. I'll just try to touch up as much as possible. So as we all know, what income from other sources tries to tax is, there are two provisions basically, 56.1 and 56.2. 56.1 deals with the residuary bucket. It says whatever streams of income which are not taxable under the earlier heads of income, like profit and gains from business provision, capital gains, salaries, income from house property, whatever is not taxed there, it automatically falls under the other sources bucket. That is what 56.1 says. There is no listing of incomes under that provision basically. It's a general provision. 56.2 provides for certain specified streams of income. As in certain items of incomes are specifically taxed under the head income from other sources. And then 57 basically provides for certain deductions under the head of income. 58 says what items are not taxable, and 59 basically is a general provision, like it just says whatever deductions we would have allowed, assuming for a moment we allow a deduction in an earlier year and subsequently it gets reversed, that whatever deduction you got in the earlier year will automatically get taxed under 59. It's similar to provisions of 41, wherein an allowance would have been given in an earlier year, but subsequently when that allowance gets reversed, you need to offer it to tax because the deduction would have been claimed in that year. So this is how the income from other sources is basically bucketed. So as I told you, 56.1 does not provide for any streams of income. This is just an illustrative list as to what gets taxed here, like family pension, subletting, non-agricultural vacant land. If a land consists of building and property, automatically it falls under house property. So a vacant land gets taxed. Income from vacant land gets taxed here. Agricultural land is not taxable. So other than this, these are certain illustrative examples as to what gets taxed here. Interest on income tax refund, agricultural income outside India is taxed here. So something of this sort. Just an example. Moving on, this is just an illustration as to what gets taxed here. So income earned by an MLA, basically are politicians, for example. Let's say the politician receives some income from the state government on account of some medical expenses. So that the officer tries to tax it under income from salaries. Salaries, as we all know, you will tax it under that head only when there's an employer-employee relationship. But in the case of a politician or a member of a legislative assembly, there is no employer-employee relationship. Therefore, it does not get taxed under the bucket of salaries, it will get taxed under the other sources of income. Whatever the politicians receive from the government, it gets taxed under the head other sources. So this again is one more illustration of what falls under this stream of income. So what happens is, let's say a company has incorporated and it's in the business of manufacture of steel. It's not yet commenced production. It has incurred some interest on borrowings of so much amount. Additionally, some surplus funds are there with the company and it has deployed it as deposits and it is earning interest income on that. So whether the tax officer now tries to tax that interest on surplus funds as other sources, whether the department's contention is right or wrong is what we're trying to see. So one important fact pattern here is the company, though is incorporated, it's in the business of manufacture, but it's not yet commenced production. So whether still can the tax officer tax this amount is a question. So I think there's a straightforward case law on this point. The Supreme Court has said, despite the company not commencing its production, when there is surplus funds with the company, and if it deploys it elsewhere, owing to which it earns interest, that you'll have to offer it separately. While whatever interest expenditure it has got, that you cannot claim because the commencement of production has not yet started. Therefore, whatever expense the company has incurred amounting to 20 lakhs, you cannot claim that, while the interest on surplus funds will get taxed under the head income from other sources. So this is another example. As we all know, we receive income tax refunds as we claim refunds in the return. The department issues refunds. When there's a late issuance of refunds, you get interest on the refunds. So whether that interest, where does it fall? It falls under the head interest. It falls under the head income from other sources. So here is a situation where a foreign company earns a refund from the department. On that refund, it also earns interest. Now, when the department issues that interest on income tax refund, it has deducted taxes at 42%. Whether that deduction of taxes at 42% is right or wrong is what we're trying to see. As you all know, foreign companies, the tax liability in India is 40%, corporate tax rate. And other sources rate is also taxed at 40%. So that is why the department has withheld taxes at 42%. But whether that action is right or wrong is what we're trying to see. So, the foreign company has contested against this withholding and the matter has gone up to the Madras High Court, wherein the Madras High Court has applied the treaty provisions. This foreign company is an Italian company in the facts of the original case. So we have tried to apply the India-Italy double tax treaty. We have tried to see whether this 42% withholding by the department is right or wrong. There, interestingly, there's one article, the interest article. The interest article says whatever interest you receive on account of debt claims, all those interests will be taxed as interest, which means under the Act, you get taxed on the income from other sources and not the business income. Even under the treaty, you get taxed as interest. Now, one more additional catch here is whatever, this being refunds, the Madras High Court has said that this is more in the nature of debt claim, because basically the government is now liable to pay refunds to me, because that being a debt claim, it automatically falls under that clause. The catch under the India-Italy treaty is whenever the government pays any interest, whenever the payer is a government, whatever stream of income the government pays, that is automatically exempt. So a similar clause is provided under various countries' double tax treaties with which we have entered. So in this case, whatever interest on income tax refund which the government has paid, that is exempt because the government has paid it. So therefore, by virtue of the treaty provisions, the associate has tried to get the matter in its favor. So in other words, interest on income tax refund is taxed on the income from other sources. This being a foreign party scenario, we have tried to invoke the treaty provisions, double tax treaty provisions. And under the double tax treaty, since the government is the payer, the receipt is basically exempt in the hands of the foreign company in India. Not sure if you're able to read it, I'll try to read it out. So this is taxability of interest on bank deposits. So assuming a person places a deposit of 10 lakhs, he earns interest on that 10 lakhs amounting to 80,000. And on that deposit, he has tried to obtain a loan. Placing the deposit as security in another bank, it has tried to obtain loan. On that loan, there's an interest expenditure of 50,000, let's say. So there's an interest income of 80,000 on the deposit. On placing that deposit as security, you have incurred an expenditure of 50,000. What the associate has tried to do is, it has tried to offer the net income, 80 less 50,000, 30,000. Whether that is right or wrong is what we're trying to see. As you all know, interest on bank deposits, you will have to offer it straight away under the current scheme of tax. There is no deduction allowed under the current law. And what the associate has done is, interestingly, it has deducted this interest expenditure which it has incurred on the loan, stating that by placing the security deposit, by placing the deposit as security and obtain the loan, it has tried to say that I have earned this interest income on one hand, and on the other hand, I have incurred this expenditure for the purpose of earning income. But that argument it's not basically bought by the courts, and the Supreme Court has ruled against the revenue in this case. Any income amounting to interest on bank deposits will have to be offered under income from other sources without any deduction. The premise is, unless there is a specific provision which allows you a deduction, you cannot take the deduction benefit basically. So under 57, you have certain amounts which you can claim as deduction while computing the income from other sources. If those items of deductions are not listed, you cannot claim any deduction aside from that. I think this is pretty much straightforward point, because any interest on bank deposits, you'll have to offer it. You might have incurred X, Y, Z amount of expenditure to earn the deposit, but does not mean you can claim it while offering it to tax. So do let me know if I'm going fast, or if you have any questions, let me know. So we have just tried to move on to 56.2, wherein certain specific items have been listed as taxable under this head. So first one being dividends. And moving on, it says casual income like your lotteries, puzzles, races, games, all those things are taxed here. Sums received from employees as contribution, like companies receive contributions from employees, and if those employee contributions are not deposited with the appropriate authorities, that gets automatically taxed here, provided the same is also not taxed under business income. That's the catch. Then you have interest on securities, provided the same is not taxed under business income. Your letting out of plant and machinery is taxed here, while your letting out of building is taxed under IHP or business income, depending on facts and circumstances. Then letting out of buildings is taxed here. When you're letting out of plant and machinery, it cannot be separated. For example, your cinema halls are there, wherein you try to let out. Your buildings cannot be separated from the cinema hall. The objective is to let out plant and machinery, whereas the buildings are also a part of that plant and machinery that you can't separate. So such kind of letting out will get taxed under IOS. Whereas when there is a proper building which you let out for residential or commercial purpose, depending on the objective, it gets taxed under business income or income from house property. Then you have your sums received under Keyman insurance policy, which is taxed here. Then the large part of the four aspects which we are going to deal in the next maybe 1 hour or so, taxation of gifts. So 56.5 and 6 currently are not there under the Act. It was at a point in time when the original taxation of gifts came into picture. So then 56.7 currently phased out, 56.7a also currently phased out, but it will apply until March 2017. 56.7b deals with share premium taxation currently in operation. 56.8 deals with interest on compensation. Now, interest on compensation is nothing but you have your lands, buildings, which typically, if assuming you own a land or building elsewhere in Chennai, and the government now comes back and tries to acquire those lands, and on account of which it pays compensation. Now, on such compensation, whenever there's a dispute, you raise it before the appropriate authority. You get interest on such compensation because the compensation goes into dispute, and over a period of time, you get either the same value or an appreciated value. On such amounts, you get interest. That interest on compensation is taxed here. Then forfeiture of advance money. This is a new provision which has come recently. So, under the before introduction of this provision by way of Finance Act, I think 2014 was when this forfeiture of advance money came into income from other sources. So let's assume I am holding a property and I'm trying to sell that property to another person. Now, while negotiating the sale, I try to get an advance from the buyer, stating that you will finish this transaction on X date or Y date. Failing which, I will hold back the deposit. Now, that deposit, assuming the transfer or negotiation does not take place, the deposit is with me, right? So, what happens? I would have invested in property X at 100 rupees. I would have earned a deposit from this guy, but this transaction would not have materialized. So that becomes an income from me. So ideally, before introduction of this provision, what used to happen was that forfeiture of deposit, whatever deposit I withheld, that used to get adjusted from the cost figure when I acquired the property, and automatically the differential portion used to get taxed in capital gains at the time when I sell the property. Now, what the department has come back and told is, in a year in which you forfeit, offer it as other sources and leave the cost part as it is under capital gains. So that's forfeiture of advance money that gets taxed under 56.9. If it is an individual, you tax it depending on the slab rates. And lastly, the 56.11 is a new provision. It says whatever compensation you receive on account of termination of employment, that you offer it here. And in between 56.9 and 11, there's 56.10, which is a combination of 56.7, 7A. The gift taxations have now been combined into a single provision, 56.10. So currently there is, as of date, there is only 56.10 which deals with gift taxation. Nevertheless, I'll try to explain the erstwhile provision because to that extent it is relevant. Going forward, the disputes which could arise on account of the last 2-3 years will be dealt with the earlier provisions.
When that 1C and the other thing would be
1C and?
when it will occur now?
1C is it? 56 to 1C. Yeah. So 56 to 1C is a case where I am an employer. Let's say I'm X Private Limited. I have employees in my company. So what typically happens is employees basically subscribe to PFs, right? Provident funds. So there is an employee contribution, there is an employer contribution. So employer usually matches the employee contribution. So what happens? Employee contribution is typically withheld from this salary. So I have it. So PF laws, ESI laws have a prescribed deadline. You have to deposit that there within such deadline. In the absence of which you hold employees' money, that becomes an income in the hands of the company. So that ideally gets taxed under business income. If you don't offer it under business income, you should offer it under IOS. So basically it's nothing. It's ideally an income in the hands of the company. Only thing is that the head differs because if I were a company, I would have offered it under business income at the same 30%, under IOS also 30%. Does not matter actually. So if you don't offer it under profit and gains from business or profession, you offer it under income from other sources.
Can we do that?
Yeah, so it's not, typically companies, what they do is they offer it to tax. Tax rate is 30% for IOS as well as business income. Just the head differs. So there is nothing much about the 56 to 1C as of date.
But where this deviation will arise? Normally,
Correct, that does not arise. So to that extent, that's written, and that's why I just briefly spoke about it and then just moved on. I don't think practically we face such issues. So moving on. So I think we just spoke about one example of a letting out of a theatre. Similar to that, let us see one more example. So in this case, there's an agreement between two parties that the primary object of letting out will be letting out of building. So usually you have furnished apartments, unfurnished apartments. So where there's a furnished apartment, the object of me, the landlord, will be to let out the building primarily, but there will be additional right to use the furniture when such object is very much clear in the agreement or when such object is very much clearly shown the tax authorities have come back and said that it will be taxed under income from house property because the object is to let out the property as such. Just an additional right to use the furniture doesn't mean that you will have to tax it under IOS. So there's a Supreme Court ruling on this context. So this is taxability of casual income, like what we saw, like there's a betting which you do and on account of which you earn income. And also there are other crossword puzzles, lottery income, whichever you receive. Such casual income on account of no skill, such income gets taxed under income from other sources. The penalty which we pay on account of earning such income is that you don't get any expenditure which you can claim against the income. You cannot have any Chapter 6A deduction on such income. And you have this provision, right? Like your income limit, basic exemption limit is 2,50,000. And assuming you have a capital gain income of, let's say, 60,000, short-term capital gain or long-term capital gain. So 60,000 is your long-term capital gain, and you don't exceed your basic exemption limit. The differential, whatever you don't exceed, you can set it off against a capital gain, you can offset the balance. That adjustment is not permitted against casual income. A casual income, whenever you earn, you will have to offer it at flat 30%. And the other point here is, assuming I am a distributor of the lottery, so I conduct lottery competitions or I hold lottery tickets and I conduct event now. And people come and buy the ticket, and depending on whatever the luck is, you get the prize or you don't get the prize. Now, once the event is over, whatever tickets remain unsold with me as a lottery distributor. So what happens is there's a dispute again. So when there's an unsold lottery ticket with me, how do you tax it? Whether you tax it as business income or you tax it as other sources is the dispute which typically arises. The taxmen come back and say it is typically other sources because you tax it at flat 30% without any deduction, whereas the assessees try to argue that it is business income because I am in the business of lottery distribution and therefore I will offer it as business income and claim the deductions. But I think there are contrary rulings of that. Kerala High Court has ruled it in favor of the revenue, wherein it has said that no, because as in they tried to rule that it is taxable as income from other sources and not business income, whereas the Guwahati High Court has ruled it in favor of the assessee, holding that it is taxable as business income. So let us understand the reason behind the Kerala High Court's logic. So in the case of a lottery distributor, whatever tickets basically I hold, which remain as unsold, they're basically valueless. Once the draw is over, those tickets are mere paper. That's what the High Court has said. So there is no skill involved. So either you win those tickets or you don't win. Once the competition is over, those tickets are useless. Therefore, you can't come back and say, unlike in a case of a proper inventory, wherein that inventory is usable, you can sell it. Tomorrow, when in the case of a lottery distribution, you can't sell the remaining tickets. And therefore, whatever balance unsold tickets you have, if you have a ticket which gives you prize money, it is worth, otherwise it is useless. Therefore, the unsold tickets basically get taxed under income from other sources. So this is the example which I just quoted some time back, interest on enhanced compensation. So let us assume for 4 years, the compensation disputes are there. So there's a land which I own, and now the government tries to come back and acquire that land on account of XYZ reasons. On that acquisition, government pays the money. I am in disagreement with that compensation. I fight it out. The compensation increases, decreases, or stays as it is. Whatever be it, I receive interest on that. Let's assume I have received so much of interest in various years, and accrual happens in respective years, but the receipt of so much of 10 lakhs or 12 lakhs, whatever be the amount, happens in year 4. Now, the provision pertaining to interest on enhanced compensation is that you offer it under income from other sources, but the method of accounting employed by the assessee does not matter only for this stream of income. In the year in which you receive alone, you can offer it. That's the benefit of this provision. Because you do not know how much interest you will receive or what kind of arrangement you will end up with the government. So therefore, until the dispute is over and until you receive the money, you don't have to offer it to tax. The year in which you receive, you can offer it. The only deduction you can take against this amount is 50% of whatever you receive is availed as a standard deduction. So the balance is offered to tax under income from other sources. Only for this, there is a receipt-based taxation. So this is forfeiture of advance money. I think we just spoke about it. So not spending time on this. So deductions under 57, as I said, limited deductions are specified. Whatever deductions are specified, you can claim. Balance, you can't claim. The gross-based income has to be offered for taxes. As in, for example, for dividends, today dividends are exempt in the hands of the shareholder. Assuming, in the case of a company earns dividends outside India also. Whatever dividends it receives outside India, such dividends have to be offered for taxes. On that dividend, if there is any income, you can, if there is any expenditure which the company has incurred to earn that income, you can claim as a deduction. And what we discussed just 10 minutes back, I think if employee-based provident fund contributions are withheld by the company and such income is offered to tax, whatever expenditure you incurred on account of that, you can claim that as a deduction. Like income from letting out of plant and machinery. Basically, to earn a particular income, if XYZ of amount has been spent, that amount can be claimed as deduction. Balance, you can't claim. Okay. So, this again is an interesting example. So, company has borrowed some amounts, and on such borrowal, it has spent some interest. And on that interest, since there is a default in the payment of interest as well as principal, on that default in payment of interest, again there is an interest on arrears basically. Whether that interest on arrears is allowable as deduction or not, the court has held that whatever interest you expended on for earning the income, that can be allowed as a deduction, whereas whatever interest on arrears portion is not for earning income, that cannot be allowed. So these are amounts which are not deductible under section 58. So any personal expense, any payments which you make outside India without deduction of TDS, all those sums are not deductible. Any income tax, wealth tax paid, no deduction can be allowed. Barring this, I think this is what income from other sources largely deals with. Okay, so what we saw was more of general items of income which get taxed on income from other sources. Moving on to some specific items. This is provision 5627, which was applicable until March 2017. This deals with basically taxability in the hands of an individual and an HUF. Only these two persons are taxed here. It is a receipt-based tax. Assuming person A gifts me some amount, that gets taxed in the hands of the individual who has received that amount. So we'll just see what this provision says. So basically, let me just go back to some history. So gifts were basically governed under the Gift Tax Act, 1958. So until then, there was no provision under the Income Tax Act which dealt with gift taxation. So 1958 till 1998, the gift taxation was dealt with that act. So owing to, I think, more of administrative reasons, that act got abolished in 1998. Between 1998 and 2004, there was no provision dealing with gift taxation, either under the Income Tax Act or under the Gift Tax Act. Now in 2004, the Income Tax Act introduced a provision pertaining to gift tax. It basically just said amounts exceeding 20,000, only money. Amounts exceeding 20,000, if a person receives, that amount will have to be offered to tax, because basically what happens if I gift X amount to you, there's no reason. If we both are unrelated also, if I will just gift an amount and I'll just walk away, as in it triggers more of black money, right? So the provision was more brought into curb black money, and it was more brought into to prevent money laundering kind of dealings. So the provision of 2004 said if amount exceeding 25,000 if a person receives, being an individual or HUF, that amount will get taxed under income from other sources. So that was there until 2006. In 2006 again one more amendment came which said the amount threshold was increased. So from 25,000 it moved to 50,000. Amounts exceeding 50,000 will get taxed under income from other sources. The same persons were covered, individuals, HUF. Companies and all were not covered at that point in time. So this was in 2006. Till 2009 there was no amendment. 2009 there was one more amendment which was brought in. So that covered money as well as property. Property being immovable as well as movable. Certain specified properties were listed under the Act, and if any gift of such property were being done, that also got taxed. So in 2009, again the same provisions were there. Individual HUF was there. 50,000 was the threshold. And if you receive money, if you receive property, being certain listed properties are there, I'll go to that in some time. Immovable property being land or building, all those things were brought. The idea behind this was, since only money was covered, people started gifting properties, like shares, like properties, land, building, jewelry, everything. So that also got covered under the income tax net. So 2009 this happened. So 2010 one more amendment was brought into the act. So the government thought like only individuals and HUFs were being targeted. So companies and firms were escaping this tax net now. Now assuming I'm a company X private limited and I have shares of X private limited, I'm holding shares in another company, and assuming I transfer the shares for free to another company, that was never getting taxed. So in 2010, what the income tax department or what the Ministry of Finance did was, it brought into one more amendment stating that in the case of firms or closely held companies, because widely held companies, public companies, listed companies, this sort of practice cannot be done basically. So in the case of closely held companies, what happened was, whenever there's a gift of shares which were held in closely held companies, if you transfer shares of a private limited company to another person, the recipient got taxed. The assessees were now expanded. Individual HUFs were covered, and also firms and companies which were not being widely held, those companies were also being covered. This was the amendment which was brought in 2010. So this is basically the amendment up to 2010. In 2013, what happened was, there was one more amendment which came. So to put into perspective, in the 2009 amendment, when I said money was being taxed, immovable property was being taxed, movable property was being taxed. So in the case of immovable property, transactions without considerations, transactions with inadequate consideration, both were being covered. Assuming the consideration, the worth of the property is 1 lakh, and let's say I've not even paid a rupee, I've just transferred this. Now that is without consideration, that gets taxed. Inadequate consideration scenarios, 1 lakh is the worth of the property, I'm just transferring 20,000. So there's a huge difference, right? Merely because I've not paid a rupee and merely because I paid 20,000, there should be a distinction. So what the government did was, inadequate consideration scenarios were also brought into the tax net. So that got taxed. In 2013, that inadequate consideration scenario alone pertaining to immovable property was removed. Because what usually happens is, you book a property today, and let's say you take possession of the property 2 years down the line. So that could be a differential amount. So I think assessees were feeling the pinch on account of that, and therefore the government thought we'll remove the inadequate consideration part alone from the tax net. And without consideration scenarios, when I just transfer an immovable property for free, those scenarios were covered, but inadequate consideration scenarios alone were removed in 2013. And I think within 2 years again, the inadequate consideration scenario again came back into the tax net. So overall, to put it in summary, today individuals HUFs, where there is transfer of money more than 50,000 taxed, where there is transfer of certain movable property, where the fair market value of the movable property is more than 50,000, that is taxed. Immovable property being land and building, whatever value you register for stamp duty purposes, if that is 50,000 and plus, that also you tax it in the hands of the recipient. If it is for without consideration, you tax the entire stamp duty value, the entire fair market value. And while it is for inadequate consideration, the differential portion, assuming the stamp duty value is 1 lakh, whatever consideration you paid, let's say you paid 20,000, the difference is 80,000. If that 80,000 is more than this 50,000 threshold, that gets taxed in the hands of the recipient. Everything is taxed in the hands of the recipient. So this is what I was talking about. So immovable property, if it is received with consideration, nothing is taxed. Without consideration, where the stamp duty value exceeds 50,000, the whole of the value gets taxed. If it is for a consideration, I think the differential amount, if that exceeds 50,000, that gets taxed. So here again, if we dispute the stamp duty value itself, there are mechanisms to approach the officer, there is a valuation officer, and that goes into a dispute, then the value comes into, the value comes into a proper fixed value after the dispute is over. That value has to be allotted. So this is in the case of mobile property. So I was telling you, right, like there are certain specified properties around which gets covered. In the mobile property scenario, only land, building or both is covered. In the case of mobile property, only these assets are covered. Shares, securities, jewelry, archaeological collections, drawings, paintings, sculptures, work of art, bullion. Aside from these, if any asset is being transferred, still today there is no tax liability in the hands of the recipient. Only listed assets, specified assets which are listed under the Act, which you transfer it without consideration or for inadequate consideration, only those assets get covered. So this provision is there up to March 2017. After that, this gets automatically bucketed under 56.210, wherein the scope has been expanded. I'll just come to that in a while. This is just a summary of what we discussed maybe 5-10 minutes back. So money without consideration, 50,000, it is taxed. Mobile property, whatever we listed without consideration, it's taxed in excess of 50k. Again, for inadequate consideration, whatever is the balance, if that exceeds 50k, it gets taxed. Immovable property, the same scenario. Okay, so any provision, I think as we know, there are certain exceptions also. Likewise, 56.2.7 also has some exceptions. If the gifts happen between relatives, it's not taxed. If the same happen during the occasion of a marriage, does not get taxed. Under a will, inheritance, no, it does not get taxed. Contemplation of death does not get taxed. Certain specified people are also exempt. Local authority, fund, trust. And certain specified transactions. In the case of business reorganizations, in the case of corporates, you have a lot of business reorganizations, mergers, demergers. In certain select cases, again, those gifts, basically they come out of the tax net. Certain exceptions have been provided. So, relatives. Who is a relative? I think this is the definition of relative. In the case of an individual, your brother, spouse, sister, spouse, your daughters, lineal ascendant, descendant, basically, everyone is covered. So, if I am the individual, my ascendant, descendant, everyone is covered. Likewise, the spouse, ascendant, descendant, everyone is covered. And brother, sister, these guys are covered. One or two slight aspects of that. So, the point here is, if a gift is being received between a relative scenario, if X transfers Y amount, if X transfers to Y a certain amount, if that transaction is between a relative, that is out of the tax net. So likewise, in the case of a HUF, as I said, 56.2.7 applies in the case of an individual HUF scenario. For the HUF, a member is a relative. So here is a scenario where certain questions, we just try to address some questions just to see if we have understood the provisions. So here B is a member of HUF, and so a HUF receives the property from B, that is a member of HUF, without any consideration whether the HUF is taxable. In this case, since the property is received from a relative, it's not taxable. The reverse scenario, the HUF receives from a member. Sorry, the member receives from a HUF. In that case, it is taxable because the member is not a relative. So in the case of a HUF, if the HUF receives from a member, that is exempt. But when the member receives from HUF, member is an individual. He receives the property in the individual capacity. So there is no exemption for that. So when the individual receives from the HUF perspective, that gets taxed. Whereas when the HUF receives from a member, that is exempt because HUF and members are relative. So that's the second scenario. Third scenario is, let's say X receives a gift of bullion of so much on his birthday. So birthday scenarios are not covered, basically only marriages are covered. So therefore that is taxable. And Z received a wristwatch amounting to so much. So I told you, right, there are certain specified assets which are listed. Only those assets, when we receive, that gets taxed. Wristwatch is not an asset listed under the Act, so that gets out of the tax bucket. And person A receives so much of cash gifts of 75,000 from a brother's mother-in-law. This is taxable because brother's mother-in-law is not covered as a relative. So moving on, 56.2.7a is more to do with taxability in the hands of a company which is closely held as well as a firm. So all this while we were seeing about taxability in the hands of the individual HUF. Now we are going to deal with taxability in the hands of the company which is closely held and a firm which is a recipient. So what used to happen, so this amendment came in 2010. Until 2010 there was no such provision under the Income Tax Act. So what used to happen before that was, so I am an X Private Limited, I am holding shares in Y Private Limited. There's another company, Z Private Limited. I am transferring shares which I have held in this company to Z Private Limited for free or for a lesser than market value transaction. So what used to happen was unlisted company shares were being transferred for either free of cost or were being transferred for inadequate consideration. Because closely held companies, private companies, there's no regulator basically. I'm holding shares in ABC Private Limited, I'll just transfer it for free, or the market value could be XYZ, let's say it is 100 rupees, I might do the transfer for 50 rupees. So the recipient is being benefited out of this transaction. He either receives it for free or he receives it for inadequate consideration. So that kind of transactions were never being taxed before 2010, and in 2010 this amendment came in order to curb this practice. So 5627A says this, the transferor can be any person. It can be a company, it can be a partnership firm, it can be a listed company, individual, anybody can be the transferor. The transferee should be either a firm or a closely held company. Closely held company by meaning private company or an unlisted public company. The property which is being targeted in this section is shares of a closely held company, which is nothing but shares of a private company. So the recipient should be a private company or a firm. The shares, the asset in question should be private company limited shares, as well as it should be a private limited company shares. The transferor can be any person. It can be a listed company or an individual, anyone. So again, there are certain exceptions to this. So your corporate reorganizations are kept out of this ambit, owing to certain reasons. So let us just see some interesting case studies to deal with the applicability of this provision. So X is holding listed company shares, tries to transfer it to a partnership firm. So do you think this provision is applicable? It's not applicable because the shares which are being transferred, listed company shares, what was targeted in 5627A was only unlisted company shares, being either private or unlisted public. So since listed company shares are being transferred, you can't do it either at a below market value or for free. So the second scenario is, now X Limited is a listed company. So as I said, the transfer can be any person. So listed company is transferring, Y company is a private limited company. Now X Limited is holding B Limited. B Limited is an unlisted public company. Shares of an unlisted public company can be transferred, that is covered under this provision. The holding is 25%. Why I am laying importance on that is, so I used to say, right, closely held company, closely held company. So the Act provides for a definition. When a listed company is holding the shares of an unlisted public company, it automatically gets called as a public company. But in this case, there's a specified threshold. Only 50% or more of holding will get that qualification. In this case, there's only 25% holding. So B company is still an unlisted public company, which is a closely held company for this purpose of this transaction. So when you transfer shares of B Limited to Y Limited, the provision gets attracted basically. In the earlier case, you held shares of a listed company that wasn't covered. In this case, had X Limited held 75% here, then the provision would not have attracted because I'm holding more than 50%, which means B company is now a widely held company because it's being held by a listed company. So in this case, since it's only 25% holding, when you transfer shares of B to Y, the provision gets attracted and you'll have to do it at that market value. If you do it at lesser value or if you do it for free, you get taxed on the fair market value. So this fair market value, the stamp duty value, there is a set of provisions. Stamp duty value, you can get it in the public domain. The fair market value of, let's say, of a share, which is mostly the dominant transaction, leave around this jewelry, archaeological collections, for which there are valuers who provide the value. Today, I think shares are being transferred. Shares is the most important movable property which is doing the rounds. So for valuing shares, there's a specified set of mechanism which is provided under the Act. So you do the valuation of that shares using that provision. I come to the valuation towards the end. Okay, so here are a couple of scenarios which we are going to address. So the first scenario is, So 5627A, I think individual HUF are out of ambit. Only companies get into picture. So a foreign company is gifting shares of an Indian company to another foreign company where the provision is attracted. So I think in this case, two non-residents are involved. Now we're trying to deal with non-residents here. Whether the recipient foreign company is liable to tax in India is what we're trying to see. The shares are shares of an Indian company. It is a private limited company share. The recipient is a foreign company, whether it is taxable or not, is what we're trying to see. So for that, a non-resident is subject to tax in India on either receipt basis or accrual basis. So income which is attributable to assets located in India, the non-resident is liable to pay taxes in India. This being shares of an Indian company, the situs of the shares is in India. Therefore, when the foreign company receives shares of an Indian company, it means it has earned income in India. So therefore, the provision is attracted here. Now it depends on whether the foreign company is liable to tax it. So we were in the first situation. We were just trying to address whether shares of an Indian company can be subject to tax in the hands of the foreign company. So the shares, the situs of the shares, since it is in India, the foreign company is subject to tax in India on this transaction. The provision is applicable. What we need to see is wherever the foreign company is located, we can just try to see if the treaty provisions can be invoked, because the provisions of 5627A is under the Indian Income Tax Act. A similar provision is not there under any of the treaties with which India has entered into. Let's say the foreign company is situated in US. The treaty between India and US does not have a similar taxability aspect in the treaty. So therefore we can, as in when the foreign company is subject to this provision, it can either opt for the treaty or the act, whichever is beneficial. So if the treaty does not provide for a similar taxability in the treaty in which India has entered into, it can opt for the beneficial provisions. So likewise, the second provision is foreign company gifting shares of another foreign company to a resident company. So this is just a flip of the first situation. Shares of a foreign company are being now gifted to a resident. In the case of a resident company, be it a company, it is taxable on global income. So despite the shares of a foreign company being received, you will have to pay taxes on that if you have done an inadequate consideration scenario or a no consideration scenario. The third situation is resident company gifting shares of a foreign company to another foreign company. So here, the provision does not get attracted simply because of the reason that the recipient is a foreign company, it receives shares of a foreign company. Both being outside India, this transaction is out of this provision. Okay, the last situation is quite a little tricky. So a foreign company is holding shares in a foreign company. There's another foreign company. So whatever shares it held in another foreign company, it gifts to another foreign company. So there are three foreign companies involved. The transferor, transferee, and the shares which it holds, all three are foreign companies. Now beneath the company whose shares are being transferred, there's an Indian company. So what happens here is, foreign company holding foreign company shares, transferee being foreign, the shares which is being transferred, that company holds an Indian asset, which is the Indian company shares. So since the recipient, although it receives an foreign company shares, that share value gets derived from Indian company shares. That is nothing but, in plain language, it's called indirect transfer. So the company A holds B, both of them are foreign. B holds C, C is an Indian company. So shares of B will derive value from C because that investment is sitting in B's books. So when you do this transfer, whatever shares which was a foreign company shares, since it derives value from Indian assets, it is deemed to be located in India. And therefore, again, the provision is attracted. We need to see whether the treaty provisions are beneficial or not. In none of the treaties where India has signed, I think more than some 80, 85 countries, India would have signed double taxation treaties. In none of them, we have a similar taxability scenario. This taxability scenario is provided only under the Act. Most other income, so this is income from other sources. So in the tax treaty, you will have something called as other income article. So that other income article is a residuary article. So it will again fall back to the local laws. But certain countries, let's say Germany for instance, even though it falls back to the Indian provisions, it will refer back to the Indian provisions, which means all these provisions get attracted to the foreign company, but the taxing rights will not be there with India. It will say whatever other income the foreign company has earned, it will be subject to tax in that country but not in India. So the reason for double taxation is you should not get taxed here as well as there, right? So whenever a foreign company receives shares of an Indian company or in these kind of circumstances, it will anyways be paying taxes elsewhere. So it does not have to pay tax also here. So that is why treaties come into picture in the case of a foreign company scenario to avoid double taxation. So this is again, we are trying to see if the provision of 56(2)(7)(a) is applicable. So here what happens is X and Y, the transaction is between X and Y, shares of Indian company are being transferred. Both the companies are listed outside India. So the closely held company which we were talking about all this while, under the Income Tax Act, companies which are public, companies in which public are substantially interested. This phrase is defined. So in 56(2)(7)(a), 7(b), all these provisions, a company which is not a company in which public are substantially interested. This is the kind of phrase which is being used. This is the language which is used. A negative language is used. So definition of company in which public are substantially interested. So if a company is a company in which public are substantially interested, these provisions will not apply. It is nothing but a listed company. So that definition under the Act only provides for, so if this company had been listed in India, let's say X and Y listed in India, it would mean that the company is a company in which public are substantially interested, because a listed company shares which will be held by public. So if these two companies, given that they are listed but listed outside India, the benefit of a company in which public are substantially interested, that character does not get attributed to those companies simply because these companies are listed outside India, and a foreign company cannot basically list in India. Unlike an Indian company which can list outside India subject to satisfaction of conditions, a foreign company cannot list in India. Since a foreign company cannot list in India, despite the fact that they are listed, these companies will be regarded as closely held companies for the purpose of gift taxation. So they might be listed in Germany, still they will have to be subject to the provisions of 56(2)(7)(a). So we will have to basically undertake the transaction at market value. So this is 56(2)(10) with effect from April 117. Whatever we spoke until now, everything has boiled down to 56(2)(10). As in individuals, HUFs, company which is a closely held company, firms, every person is now taxed under 56(2)(10). In addition to whatever we saw, the scope of the section is completely widened, which means till now we never saw a case where a listed company was receiving shares. As in, if a listed company being a recipient, the provision was not attracted. Today the provision is completely widened. The provision says any person receiving from any person. So which means the transferor can be any person. The recipient can be any person. The assets remain the same. Immobile property, movable property. That definition remains the same. The only damage with this, which the government has done, is it has just widened the recipient base. Until now, only 3 persons were covered: individual, HUF, closely held company. Today, everyone is covered. Any company is covered. So that is the only change in 56(2)(10). Remaining all, rest all remains the same. So this is just a summary of this. So given that I think 56(2)(10) also largely revolves similar to 56(2)(7)(a) and 7, I'll just skip this provision. Some interesting case studies alone will deal. See, for example, in this case study, what happens is X is a company in Germany, it holds shares in B, Y is the recipient, B has 2 divisions. Division 1 is manufacturing, division 2 is trading. What it does is B transfers this division 2 to Y Limited, which means B and Y are Indian companies. It can be private, public, anything. The provision is attracted. When it transfers this division 2 as an undertaking to Y, it transfers it for free. Now, tell me just whether this section is attracted here or not, because what we discussed until now was a movable property being land or building, movable property being shares, securities, your jewelry, archaeological collections, and another few kind of assets. So, the undertaking, now what B Limited does is, it has two divisions, two businesses, manufacturing, trading. The trading business as a whole, let's say 4 assets and 4 liabilities are there which is pertaining to this trading business. The business as a whole gets transferred to Y for free. So, this kind of a property is not defined in 56.210, which means when you do such kind of a transfer for free, still the provision does not get attracted, because whatever property is being listed in the section, only for such properties the Act will apply. For the remaining transactions, there is no tax liability at all. So when you do this gift, what happens in effect is the transferor is exempt from tax because it's a gift transaction. In capital gains, gifts are being exempt from tax. In other sources, this kind of undertaking is not covered as a property. Therefore, the recipient also does not pay tax here. So this is just to show that a business undertaking is not a property for 56.210. So what we saw till now was 56.2.7a and 7, wherein the exceptions were largely restricted. What 56.2.10 has done is, it has covered all sorts of persons. Basically, any person can do the transfer, any person can be the recipient. The recipient has to pay tax on this when there is a below fair market value transfer or when there is no consideration cases. One exception which is applicable is, let's assume X Limited, which is a foreign company, it holds shares in B, it holds shares in Y. Both are wholly owned subsidiaries. Now, in group restructuring, what typically happens is, for various reasons, X now wants to transfer shares of Y to B or B to Y in either case. Now, if you do a normal sale, it has to pay taxes in India. But if you do a gift, you have a capital gain exemption. So when X transfers shares of B to Y for various reasons, this is the resultant structure. X is holding B. Until now, X was holding B and Y as 100%, 100%. This being the resultant structure. The shares of Y are being gifted to B, which means X will hold B, B will hold Y. The transaction is being done by way of gift. One, the transferor can avoid capital gains tax by doing this. Secondly, in the case of 56.210, wherever there is a transaction between a holding company and a wholly owned subsidiary, that is outside the purview of gift taxation. Which means if a company X is there, it owns subsidiary entire share capital, 100% should be held by the holding company, and transactions between them are completely out of the purview of gift taxation, similar to capital gains. So, in the case of capital gains, had you done a transaction between a holding company and a 100% subsidiary, that does not attract capital gains tax today. But there are conditions attached to it. But in the case of gift, the same transaction you do, the recipient also does not suffer tax. But the conditions are not attached here. So whatever conditions was available in capital gains head, those conditions are not available here. So which means you can just do a gift like this, as in X will hold B and Y. For various reasons, if it wants to transfer Y is holding under B, it could be for XYZ reasons, commercial reasons. The transaction will not attract capital gains tax because of the exemption available. Again, the recipient being B, whose shares are being received for free, B also does not have to pay any tax because it is covered under the exemption. Let us see some 4-5 scenarios and we'll just try to close it as early as possible. So, 56.210, as we all know, it applies to any person basically. The transferor can be any person, recipient can be any person. Property, listed properties, your shares, your jewelry, your archaeological collections. Immovable property being land or building. So today, let's say there's a company X Limited. For simplicity, we'll just take A and B. So B is a company which issues shares to A. Now, on this issue of shares, can you say that A Limited has to suffer the rigors of 56.210, which means, so I am issuing shares today. Let's say a listed company is issuing fresh shares. There's a difference between receiving and issuing. So what the section tries to cover is, if I am person A, person B is there, a property should already be in existence for me to give it. So if I'm giving X shares to another person, that can get covered under 56(2)(10) because the property is already in existence. In the case of shares, when there's a fresh issue of shares, so let's say if I'm holding some shares in A company, if I'm just gifting those shares to B, that will get covered because the shares are already in existence. In the case of fresh shares, only upon issuing the first time the property comes into existence. So therefore there's an argument which companies try to take is, in the case of fresh issue of shares, the provision should not get attracted because the section is worded very widely. It says any person receiving from any person. If it is shares, you need to comply with this provision. So in this case, fresh issue should not get covered because there should be receipt of property. When you're issuing it for the first time, that cannot be treated as a property because shares basically only on allotment they come into existence. That's the principle which the Supreme Court has held. And relying on that principle, we can just try to extend it in the case of fresh issue of shares. The provision should not apply. This has not been tested yet, so we need to just wait and see. So, extending this logic further, in the case of bonus issue, let's say I'm holding shares in X Limited, and now I'm owing to that initial holding, I'm being issued bonus shares, where the provision will apply. As I said, receipt of property is covered here. So now the interesting scenario is, when you hold shares in a listed company, let's say worth 10,000 rupees, let's say you're holding shares worth 10,000 rupees, and you're being issued a bonus. So bonus, basically you receive it for free, right? You don't pay any cost. So, but what happens is, once the bonus issue is done, the market value automatically dips. So 10,000 rupees worth of shares you might be having it for 500 shares for X rupees. So bonus comes into picture. The shares, let's say 1:1, so 500 becomes 1,000 shares. Now, but the value remains the same. So what typically we try to argue is, even in the case of bonus shares, the provision should not apply because bonus, though you receive it for free, but the worth of the investor remains the same. So therefore bonus shares also should not get covered under this provision. There's a ruling in this context actually. But it was in the context of erstwhile 56(2)(7)(a). You can apply the same logic because even though you receive it for free, the worth of the investor remains the same, therefore the provision should not apply. So this is another interesting scenario. So generally in the case of rights issue, what happens is, I'm issuing shares to company X. The rights will work like this. The company will offer shares to everyone. Whoever wishes to subscribe can subscribe. Balance, you can renounce it. If company X is subscribing, the balance shares it can subscribe. That's how the rights work. So in this case, what happens is, both the shareholders are being offered shares, but B does not subscribe. Since it does not subscribe, the balance shares are being subscribed to A, which means I'm 100%. Today I'm 90 and 10. But additional shares are being subscribed and funds are being received in the company. And what happens is, since B does not subscribe, the holding gets diluted now. So since the additional shares are not being subscribed, the holding changes, 99:1 it becomes. So whether this disproportionate allotment, wherein it results into increase in shareholding in A, whether that is covered under this provision is what we're trying to see. I think fairly, because of one's inaction, you can't now tax A because it was B who did not want to subscribe. So there is no receipt of property as such. Section gets attracted only when there is a receipt of property. So since neither the company issuing shares has given anything, nor the other shareholder has given anything to the first company, therefore the provision should not apply is what we're trying to say. So this is a case of buyback of shares. So again the same concept. So B does a buyback of A company shares. And what we're trying to, I think, say is, company B does a buyback. Shares which A held in B now gets transferred to B, because once the company does a buyback, the shareholder will tender his shares. Such shares will be cancelled within 7 days. That's how buyback works. So in this case, what we're trying to say is, when the shares are being tendered from A to B, whether the provision can apply. Interestingly, when the company receives the shares from the shareholder, it has to be cancelled within X number of days under the Companies Act. Therefore, those shares have no value today. Therefore, for such kind of transactions, you can't apply this section, is what we're trying to say. So this is another interesting scenario. So X is holding shares in B. Now X Limited gets converted into a limited liability partnership under the provisions of Companies Act. So the shares held by X Limited now gets transferred to the limited liability partnership, and the limited liability partnership holds shares. Whether this transfer is covered under this provision, we try to say. So the argument which we try to take is both the giver as well as the receiver should be in existence. In this case, when company gets converted into LLP, the company is not in existence. So that cannot be called as a receipt of property. Both the receiver as well as the giver should exist. In the absence of it, the provision should not apply, is what we're trying to say. I think this is interesting. So we just see this. So what happens in 56.2.10 is, assuming I'm transferring a land to another person for free. So the stamp duty value of the property is taxed in the hands of the giver. So I'm transferring a land to person Y for free. Whatever is the value which you should register for stamp duty purposes, that value, basically the market value, that gets automatically imputed in the hands of the receiver. He pays tax on that. Now, interestingly, the seller also pays tax on the same value in capital gains, because 50C, there's a provision in capital gains. When you do a transfer for less than market value, that provision gets attracted. So by double whammy, what we're trying to say is, for the same value, let's say I'm transferring it for free, or let's say 100 rupees worth of property, I'm transferring it for, let's say, 80 rupees. So what happens, 80 rupees is what the recipient will pay, but since 100 rupees is the market value, the differential 20 will get taxed in the hands of the recipient. The same differential 20 will also get taxed in the hands of the transferor by virtue of 50C, because 50C also comes into picture in the hands of the transferor. 56.2.10 also comes in the hands of the transferee. Although the persons involved are different, but the same amount is being taxed in the hands of the transferor as well as the transferee. So the government enjoys to that extent on the same transaction, though different persons, the same amount it taxes in different people's hands. So, but we can't help it, we'll have to pay taxes on that. I'll just touch upon this and we'll just wind up with this. 56.2.7b is a provision which tries to tax premium basically. So what used to happen was, share premium basically is not taxable in companies' hands, right? Because it's a capital receipt. So what companies used to do was, they used to hide the valuations. So let's say value of share A is, let's say, 150 rupees. 10 rupees is the face value, 140 is the premium. So what used to happen earlier was, companies used to load lots of money. When closely held companies used to load lots of money. In the name of premium, it used to dip in money in the company's hands. It used to get recorded as premium. Premium is not taxable either in the hands of the giver or in the hands of the receiver. So what the provision now tries to do is, you need to value the company's shares. Assuming company's share value is 150. 10 rupees is the face value, 140 is the premium. Over and above this 140, if you dip in premium, the balance excess gets taxed in the hands of the company. So fair market value is determined, 150 is the fair market value, 10 rupees is face value, 140 is premium. Up to this, you're exempt. But if you dip in 200, for example, and if you say premium, the difference between 150 and 200, that 50 gets taxed in the hands of the receiver. Because what happens is, you have a lot of unaccounted money, and that gets translated into the company's hands as share premium. That gets converted into white money. In order to avoid this practice, you need to value the shares, and in any amount in excess of the fair market value gets taxed in the hands of the recipient. That is the company which receives the amount on account of issuance of shares. So now this section applies only in the case of issue of shares. It applies only in the case of a resident investor. You can't do this, you can't play around like this in the case of a non-resident investor, because you have RBI regulations coming into picture. You can't dump anything in excess of whatever is the market value. And more so in non-resident scenarios, it's fairly regulated. The RBI takes care of it. In the case of resident scenarios, typically what happens is, there's no regulator. You just dip in share premium and the company does not pay tax on that amount. Whatever unaccounted money gets converted. So in order to plug this loophole, you needed to value shares. Anything in excess of the market value used to get taxed in the hands of the company. So that's what we try to target in this section. Section is explained, and certain exclusions are there, and transactions which are not likely to be impacted. So here, so this section is more to do with over consideration, as in when you, let's say 150 is a market value, you dip in 200. So it's not an undervalue kind of situation, it's an overvalue kind of a situation. So all your buybacks, forfeitures, capital reductions, those transactions are not impacted by this section. Because in such scenarios, you don't infuse loads of money. It's a mechanism to give away money. You don't receive money in the case of buyback. So company distributes money in the case of a buyback rather than receiving money. So in the case of bonus issue, there's no consideration at all. So there's no money flowing into the company. So there's no question of premium coming into picture. And likewise, inadequate consideration scenario, again, section does not apply because only premium, only more infusion of money, more the trouble.
In case of forfeiture?
Yeah, so forfeiture also, what happens? So assuming I am a company, you have issued shares to X Limited, or any individual investor, money would have come in. On account of non-payment of call or XYZ reason, you forfeiture the shares. So there's no additional money coming on account of forfeiture. Money already would have flown in. At that point in time, this checkpoint will apply. But in the case of forfeiture, you don't receive money, neither does the company pay the shares. The shares get forfeited. That's what happens. So that's section does.
If it in the hands of company, what will be the amount what is received as application money, which is forfeited?
Yeah. So share application money which is forfeited, it's a capital receipt basically. So does not get. So whatever money it receives, I think you're asking the money which is being forfeited on account of those shares alone,
Yes.
that does not get taxed because that's share application money. That gets forfeited, does not get taxed because that's a capital.
in the hands of company.
No, does not get taxed. So few interesting issues in 56 to 7b. I think with this we'll just wind up. So in the case of issuance of shares, there are 2-3 modes basically. Company might, so let's say an investor pumps in money in year 1 and you issue shares in year 2. So what we're trying to ask is, in which year does the taxability arise? Whether the year in which the money is infused or whether the year in which the shares are issued. I think it's fairly simple. Year in which shares are issued only determines the taxability because the section operates only when there's the issuance of shares on account of which consideration is received. Transfer of assets in lieu of receipt of shares. So not only money consideration is covered, even consideration in kind is covered. And convertible instruments, you have debentures, you have preference shares which are converted, owing to which equity shares are being issued. And even in that scenario, I think it's fairly simple. So you issue CCDs, let's say you issue convertible debentures, you receive money at that point in time. At the time when debentures are issued and money comes in, the section does not apply because it's a debenture. Section applies only in the case of share. When the debentures get converted, it gets converted into share, owing to which there might be issuance of shares. And here, I think there's no clarity yet. I think it's reasonable to say that the section will apply, although the money would have come in at a point in time, but the shares would have been issued at, let's say, 5 years or 10 years down the line, still the section will apply. Shares which are being issued to, I think, so the recipient in this case, so giver, receiver, company is there, investor must be a resident in this case. If the investor is a non-resident, the section will not apply. But the company can be a non-resident. So in this case, the fourth case, we are trying to say the company is a foreign company and the investor is a resident. So it tries to invest in shares of a foreign company, whether the section will apply. It's fairly simple since the shares are held outside India, the section will not apply. The last scenario is, I think, consideration received from a non-resident. Like I said, section will apply only in the case of a resident. In the case of a non-resident, section does not apply. But here, at the time when the consideration was received, if he's a non-resident, and at the time of allotment he becomes a resident, what happens? I think still there is no clarity. Section should apply is what we feel. Because end of the day, when shares are issued, he becomes a resident. Ideally, section should apply. So, some interesting aspects about valuation. I told you, right? Shares have to be valued in a particular manner. So, this is what it says basically. You need to compute the book value of shares. So, assets minus liabilities, you get a value divided by number of shares. So, that is the value. So, earlier, prior to I think a year back, what used to happen was shares had to be valued in book value basis. Whatever you recorded in the books, those values should be taken. Liabilities, you get the net worth divided by the number of shares, you get the share value. Last year there was a change. So what used to happen was, if I am holding shares in a company, if that company has only land as an asset, So what people used to do was, instead of transferring the land on which capital gains tax arises, because land has to be transferred at market value, your 50C comes into picture. So instead of doing that, you used to transfer the shares alone. So if you transfer shares, there's no 50C kind of a provision. So what happens is, you used to transfer at book value. So land value might be some huge price. You used to transfer the shares. The land which was sitting in the company automatically gets transferred. So people used to do this. So what the valuation mechanism today states is, assets, certain assets, they'll have to be imputed to market value. Like for example, land. So book value is what is the method. But certain assets, you need to impute the fair market value, then determine the net worth, then arrive at the share value. So this is an interesting change which the government brought about last year. So I think with this, if you guys have any questions, you can ask, otherwise we can wind it up.
With respect to income from other sources, that normally a homemaker who is running tuitions,
Right.
whether all these things fall under income from other source or it has to be taken as business income.
No, so I think, so assuming an individual is running your tuition classes, I think it can be offered as income from other sources, because I'm not very sure if assuming that happens on large scale basis, on a routine basis, and if it happens on a large scale basis, and if it is commercialized properly, then you can do it as a business. Then you can do it as a business income. But where the threshold is very less, assuming threshold is 4 lakhs, 5 lakhs, it's a small scale income. You can just say it as other sources, not necessarily that's a business. Because a homemaker running tuition, I'm not able to foresee how much income that might generate. Whereas if you do a proper commercialization of that place, let's say you run a proper tuition center, that automatically becomes a business because you do it on a proper commercialized manner.
Similarly, with respect to commissions also, small commissions which they are earning.
Yeah, right. I think commissions will fall under income from other sources.
Tuition case, where can he claim any
Commission case, is it?
No, tuition cases.
Yeah, whatever.
Any expenses?
Right, you can claim
Expenses.
to the extent whatever you have expended for the purposes of earning those income. So reasonable expenses, whatever you have incurred, you can claim it as a deduction against that income.
Any legal backing, sir? Any legal backing?
For this, is it?
Yeah.
Not in the same context, but there might be cases where your expenses are allowed. I can pull out some case law and maybe I can share it with you, but not in the same context.
Similarly, a professional is a doctor, is having a clinic.
No, that can't be offered under other sources.
Suppose he's working.
That's a profession. You need to.
No, he is
Suppose
already
he's
working.
working also, and he is running clinic also. In that case, whether that clinic income will be treated as business
No,
income
I think
or then
professional
other source.
that will not come under other sources definitely, because that is also attributed to his profession, right? You might be a doctor, but whatever clinic income also you earn, it's out of your profession only. So I think it's reasonable to say that you will have to offer it under PGBP head rather than other sources.
Why I am asking this question means, if I am treating as a business income, I can go for 4480 as long as they're within the
In which case, sir? In which case?
Tuition
case.
whatever
Commission income.
Right.
any income which I add in, even though I don't have it.
You're saying that presumptive tax you can adopt.
Adapter, if I take it as a business income,
Right.
as income from other sources.
You can't take. So if you're asking the right answer, I think it should be other sources, because not able to foresee a business income kind of a scenario, but nevertheless, if you want to take a business income stand, it should be defendable, because it all boils down as to how you portray. So you might be a homemaker, you might be handling some 10, 15 people or 20 people, 100. So that can be a business. So how the scale is, that's what determines. You can do this planning. I think what you said is workable. Not that it's never workable, but a straightforward answer will be in other sources. But if you want to treat it as business income, if you want to take benefit of that 8%, the point in 8% is assuming you earn lesser than 8%. Then you're stuck. You need to offer 8% then, minimum.
Can we show a salary income and business income together in return?
Yeah, you can. No, I think there's a specified form for that. Not that I'm able to recollect and tell you, but salary and business you can show it in this. I think ITR,
Salary and house property we can show together.
that you can do it in ITR 1, provided you have only one house property.
That is.
Salary and business income you can do. I think ITR
Because
4.
like in that example, doctor's example, if we treat that income as a professional income,
Right.
we have to
ITR
show both the incomes in the return.
ITR 3.
In that case,
by tier 3 it can be.
I think that is doable, not that it's not doable.
So in the case of senior citizen, earning interest from fixed deposits from various banks,
Right.
can they claim conveyance expenses, reasonable conveyance expenses?
No, I think expenses can't be claimed, but there's you have this 80 TTA provision wherein there is a specified amount which gets automatically, so to that extent you don't have to offer. Let's say you're earning deposits worth 15,000, 20,000, 30,000. To the extent of 10,000 you don't have to offer. There's an exemption which is provided. So that you can avail than claiming these expenses.
Offer and claim exemption.
So assuming you earn interest of 1 lakh, 80 TTA says any interest on deposits to the extent of 10,000 you can claim it as deduction. Therefore balance 90,000 alone if you can offer, that's enough. In the case of senior citizen, I think the limit has been now increased. Yeah, I think it has increased. You can claim that rather than claiming these expenses. That will cover this expense.
No, in addition to that.
In addition to that, no, I don't think that deposits you can't claim any expenses. That's not possible.
No, against direct sitting fees, we can claim this expense. So direct sitting fee should come under income from other sources.
Direct sitting fees falls under income from other sources. Not that there is any specific provision to claim the deductions. I think under the general provision of 57, so there will be a general clause. Any other expenditure incurred in relation. So I think that which is reasonable, it will say. I think if it is reasonable, I think you can.
The 80 TTA offers only for savings banks interest.
No. I think fixed deposits, it is now being included now.
It's only being considered, but it's not going to be.
No, under 80 TTP, it's
Specifically talks about savings.
only savings bank, I should say.
No, savings bank, I agree. I think fixed deposit also was covered, right? Not covered, right?
CDA is not covered.
It's under consideration.
Okay. Let me just check. Maybe I'll just check it.
Sir, loan waivers, sir. What is the position with regard to loan waivers?
I think I think loan waiver typically falls under the bucket of without considerations. So what happens is when I give you a loan, there's an obligation to repay. So this position you cannot say that there is no consideration scenario. So in year 1 I give you the loan of let's say 1 lakh. There's an obligation to repay in let's say 4-5 years down the line. So let's say in year 3 or year 4 the bank waives off the loan. So there is a dispute as to whether this waiver could be taxed in the hands of the recipient as a benefit, because on account of the waiver you are receiving a benefit. No clarity as such, but I think loan waiver will fall under this 56 to 10 given the wide application of the section, because section says any person to any person. In the case of individuals as well as in the case of companies, because a lot of banks give loan and they enter into this debt restructuring and wherein there is a lot of loan waivers. So on account of the waiver, the company which is the beneficiary receives a benefit to that extent of waiver. So in year 1, the money would have flown in. At that point in time, there is an obligation to repay. But in year 4 or 5, when there is a waiver, that time technically there is no money which is flowing into your account. But there being a benefit, I think there is a risk of tax liability being imputed on that.
Okay, limited crowd, I am just privileged to be on behalf of SIRC to Mr. Shah.
Sir, nice presentation. Can I have coffee?